What is in today's Market Navigator?
We're going to go deep into the rate side of things, Ty, and that's what we're going to do here. As exemplified by today's big economic data, the CPI, the markets may be at least getting a little bit too ahead of themselves in terms of the Fed rate expectations. But our trader here thinks that the disconnect could offer an opportunity to capitalize with a kind of trade idea. So joining us today is Manju Boraiah, the head of Systematic Edge Fixed Income with AllSpring Global Investments. Manju, thank you for being with us today. Let's talk a little bit about this notion of the CPI and what it means for the rate picture. Why do we think that the markets have gotten ahead of themselves with regard to projecting rate cuts down the line?
Yeah, it's a great point. Thanks for having me. So if you look at what came out of the Fed meeting last week, right, or last month rather, the forward guidance they gave us was like 2 rate cuts for this year and about 6 rate cuts by the end of next year. But the stellar jobs data that came out on Friday and the CPI data that came out today kind of shows that there's still risks to inflation, right? So if you look at the inflation number itself, the super core inflation is super sticky. It's still rising. The wages are still rising 4% year over year. So that actually still poses risk for inflation. U.S. economy is still on a strong footing, right? So the jobs data has been stellar. The PMI data last week was awesome. So to me, when you put it all together, the risks to inflation are still high. So to me, in using Alan Greenspan's words, right, so the irrational exuberance of the rates investors, the Fed Fund Futures is actually pricing in 2 rate cuts for this year and then about 6 rate cuts overall by the next 12 months. So to me, there's a disconnect, to your point, between what the Fed is saying in terms of them being data-driven versus what the rates investors think the markets need to do.
All right, we got that kind of confirmation with the Bostic headlines, right, about maybe it's the idea that we don't have to go.
We might pause.
We might actually pause the rate cuts. So take us through the trade. How exactly would you then capitalize on this notion that maybe the rate cutting picture has gotten too aggressive?
Yeah, so given the surprises here, right, that we have seen in the last week or so, I think there's potential for more surprises in growth, inflation, and employment numbers over the next few weeks. So I think the best way for investors to play this is to really pay rates outright in the long end of the curve. Or the best option, in my view, is to really position for a curve flattening, right? And if you look at the curve, the 3-year, 20-year part of the curve is actually pretty optimal for putting on a curve flattener. So what you essentially would be doing is you would be paying the 3-year rates, receiving the 20-year rates, and positioning yourself for what we call as a bear flattener, meaning that the short-end rates would rise higher, much faster than the long-end rates. So that is the best way to position for any potential upside surprises we would see in growth, inflation, or employment numbers in the next few weeks to months.
All right, so let's just be clear. One quick point before we let you go. This is this notion that you see basically long-end rates either moving slower to the upside or even perhaps a little lower versus the low-end rates or the shorter-term rates moving up a little bit higher. There is that flattening.
That's the flattening. That's the flattening.
That's exactly right. That's exactly right. So if you look at the curve, it was pretty flat in June, right? So what has happened, the 20-year part of the curve has actually steepened in the last 2 months or so. So there's potential for it to actually go back to the kind of the flattening structure it had about 2 months ago.
Sure.
Again, the risks from inflation and growth are kind of the key drivers there.
All right. Manju Boraiah at AllSpring, thank you very much for that. We appreciate it. We'll see you again soon.